Welcome to our Hurst Cycles webinar, our first webinar for 2017. Today is the 16th of January of that year. My name is David Hickson, and as always, before we take a look at the markets, I must ask you to please make sure that you have read and understood some disclaimers, which, if this computer will agree with me, it should display in a moment. There we go. Oh, and it skipped straight ahead, didn't give you much time. Let me take you back to those disclaimers. That's not how you're meant to present disclaimers at the beginning of a webinar. There we go. There are the disclaimers. Please make sure that you have read and understood them. Now, today's webinar is a little bit of a request show, if you like, because we've had several requests over the past few months for me to speak about what happens to the FLD trading strategy, or the interaction between price and the FLD, when you get a very strong bear market or bull market. But interestingly, most of the requests have been what happens when you get a very strong bear market. And so today I am going to be speaking about that. I'm going to be speaking about what happens to the interaction between price and the FLD when you are in a strong bear market. But I'm not just going to answer that question, because I know that many of you might not be familiar with the FLD trading strategy. And so in this webinar, I'm going to give you a lightning tour of the FLD trading strategy, an introduction to it, and a description of what it is and how it works, so that we're all on the same page in terms of what I mean about price interacting with the FLD. And then I'll actually answer the question about what happens to FLD interactions in a distorted market, because it's obviously really important that you kind of understand the basics before we start getting into some of the details. So I hope that you find it interesting. If the FLD trading strategy interests you and you have not done our course in the FLD trading strategy, or have not subscribed to Hurst Signals, then I'm offering a special for the month of January, from now until the end of January, 50% off your first month of Hurst Signals, which gives you access to a training course about the FLD trading strategy. So if this interests you, then jump into a simple 3-instrument subscription to the Hurst Signals system, and the code that you need to enter is that code that you see written there, January-2017. You can get it for half price for the first month, and you don't have to renew it, of course. So you can just do it for a month and do a part of the course and learn about the FLD trading strategy if this interests you. So let's get started. I see lots of new people joining and saying hello to everybody. Thank you for joining me live. I really enjoy having people join me live. Obviously, that's why I do these things live. So thank you very much for being here. If you have any questions as we go through this, then please don't hesitate to ask those questions. Okay, so let's get started. And we're starting right at the beginning, as you can tell. Here is a cycle. All right, I'm sure that you're all very familiar with it. This is obviously this is a sine wave representation of a cycle, and it's something that I'm sure you're all very, very familiar with. The reason I'm showing you a cycle is because I want to explain to you how it is that I came to develop the FLD trading strategy, because you should know that the FLD trading strategy was not created by Hurst. Hurst defined or discovered the FLD, which is the future line of demarcation. And Hurst spoke about the FLD and how it interacts with price. But he, in fact, only spoke about how the FLD from a single cycle is interacted with by price, and he never, to my knowledge, actually spoke about what happens when you have a price curve created by or constructed by the combination of multiple cycles, and how that price curve interacts with the FLD. If this isn't making sense to you, then I hope it will soon. That's why I'm showing you this cycle. I want to give you a little bit of background. So so we're going right back to basics here. This is a cycle, and we know that this cycle influences the market to the price of the market to move. So when the cycle is moving up, then the idea is that it is influencing price to rise, and when the cycle is moving down, it is influencing price to drop. Okay, if financial markets consisted of one cycle, then they would look very much like that. They'd look like a sine curve moving up and down. Of course, markets don't consist of only one cycle, and they don't really look very much like that at all. That's because of the fact that there are multiple cycles that influence the price movements of financial markets. So let's start looking at combining some cycles. Here's a little diagram showing two cycles, and as you can see, one cycle has a longer wavelength. You measure the wavelength as the distance from one trough to the next trough. So that sort of red colored cycle has a wavelength which is double the wavelength of the blue cycle. You can see that, I'm sure, fairly clearly. I don't need to draw diagrams about it. The wavelength of the red cycle is exactly double the wavelength of the blue cycle, and that obeys Hurst's principles. Hurst stated in his principle of synchronicity that the troughs of cycles are synchronized where possible. So you can see I've drawn this diagram to show that the troughs are happening at the same time, which is what synchronized means. And the other principle that it obeys is the principle of harmonicity, which is that the wavelength of the two cycles are related by a small integer. In this case, they're related by the very small integer of 2. So the red cycle is 2 times, or twice, double the wavelength of the blue cycle. So these diagrams that I'm showing you are obeying Hurst's principles in a sort of a subtle way. It was worth pointing that out, though, because if you arrange your sine curves in different ways, then of course you're going to come up with slightly different results in the sort of process that we're doing today. So there are two cycles. Now, what happens when you combine those two cycles in the market? Well, when you combine those two cycles in a financial market, then according to Hurst's principle of summation, there we go. I've covered 3 principles in only about 7 minutes. That's a record for me. The principle of summation tells us that when you combine the cycles, you simply add them up. Okay, so these cycles have been combined, and these are charts from a simple Excel spreadsheet, and you can see that the red and blue cycles have been added together to produce this green line. And I need to turn my pen on. Sorry, I'm dragging this chart instead of drawing on it. Let me turn the pen on. So there we go. So this green line here is the combination of those two cycles, or in other words, in our very simple model of this financial market, which consists of only 2 cycles, that is our price action. That sort of green line is our price action, the result of combining those 2 cycles. And so we can continue, because there are not only 2 cycles that influence the price movements of financial markets, there are in fact an infinite number of cycles, but we're not going to worry about the infinite number. Now we're looking at combining 3 cycles. So here are the 3 cycles. And it's worth pointing out again that these cycles obey the rules of synchronicity. You can see that their troughs are synchronized where possible. Obviously, not every trough can be synchronized. For instance, this trough here of the green cycle cannot be synchronized with the trough of the red cycle at that point, because the red cycle isn't forming a trough at that time. So wherever possible, the troughs are synchronized. They obey the principle of harmonicity, which is that the ratio between the wavelengths of the cycle is a simple small integer value, in this case 2. So each cycle is twice the wavelength of the shorter cycle. And if we apply the principle of summation, we can see what happens when we combine these cycles. And let me step forward to the next slide. There we go. That purple line is the result of combining these 3 cycles. So I'm going to let you look at that purple line for just a moment, because that purple line is really very important. It's a very important shape. And the reason that it is such an important shape is because that is the shape that cycles form in markets. It obviously gets more complicated because you add more cycles, but I'm going to speak a little bit about that in a moment. The sort of fundamental core basic shape that cycles form in markets is this purple shape that you see in front of you. And I often speak about it as an M shape, because you can see it goes up, forms a peak, comes down, has a center point, goes up, forms a second peak, comes down, and reaches the end there. So there's your M, a capital M. That's why I'm always speaking about the M shapes in the markets. There are a few other important things to notice about this shape. In particular, what is called the mid-channel pause, which is this pause that happens on the way up, and this pause that happens on the way down. So you always get a mid-channel pause on the way up, and you get a mid-channel pause on the way down. This is a really important shape, and you should probably sort of print it out and put it up on your wall when you're trading, because this is the shape that you expect markets to constantly be describing. And markets constantly are describing this shape. So there is something else that I should point out. I've mentioned 3 principles, and I'm actually going to mention a 4th one, which is the principle of proportionality. And in fact, I've distorted the principle of proportionality. I'm not entirely obeying it. The principle of proportionality, try saying that fast many times. The principle of proportionality tells us that the amplitude of the cycle, which is its strength or its power, represented on this chart by the height of the cycle. Okay, that is the amplitude of the cycle. So that's the amplitude of the green cycle there. The principle of proportionality tells us that the amplitude of the cycle is proportional to its wavelength. So as you get a longer wavelength, so you get a proportionally greater amplitude for the cycle. Now, you might notice, if you look carefully at this chart, that although the cycle wavelengths are related by a simple integer value of 2 to 1, so in other words, each cycle is twice as long in wavelength as the shorter one, in fact, their amplitude is not related by exactly directly proportional 2 to 1 ratios. So in other words, this blue cycle over here, although it is double the wavelength, is not double the amplitude. And it's an important point to make. It's because when I started fiddling around with these charts many, many years ago and trying to understand what Hurst cycles were saying about the way that markets work, I found that the principle of proportionality doesn't apply as a direct proportion. And that's why all of my charts that I show you have a slightly muted proportionality. So although the amplitude of the blue cycle is greater than the amplitude of the green cycle, it isn't proportional. Okay, in fact, it's a ratio of 1.35, which I've found over the years works very well. A ratio of 1.35. You might want to bear that in mind, because if you're going to start doing this sort of analysis, you're going to see in a moment what happens when you adjust the proportionality. The proportionality, that sounds like an odd word, the ratio between amplitude and wavelength. When you adjust it, you get slightly distorted shapes, and that's really what we're going to be speaking about today. So bear in mind the ratio of 1.35, although being a bit of a Fibonacci freak, I tend to go for the closest Fibonacci ratio, but that's just a personal thing. So here we have combined 3 cycles. Okay, I see John has read J.M. Hurst's book and worked through his course, and this is a great review. Great. I'm very pleased to hear that, John. Hurst's work was extraordinary and groundbreaking. And in many ways, Hurst cycles are a really simple approach to the markets in many ways, because you're just talking about a bunch of cycles moving up and down. But really understanding it can take a bit of extra time. So hopefully this webinar is going to help with that process. Now let's start speaking about the FLD. So we're taking a step back again, and we're going back to one cycle. There you can see the one blue cycle. And here, this dashed red line, I hope that line's coming across in the webinar. It doesn't look very clear. I probably should have chosen a different color for that. But that dashed red line is the FLD. Now, what is the FLD? I think John has said he meant course, not curse. Perhaps a Freudian slip. Yes. Well, a positive curse at any rate. So the FLD is something that Hurst defined, or discovered perhaps, and the letters FLD stand for, they are an acronym for Future Line of Demarcation, and that is because this line, the FLD, demarcates where price is likely to do things in the future. And that is that sentence just sort of comes out quickly and it's forgotten, but that's a really important thing, because as traders, we want to know what's going to happen in the future. I happen to believe personally that it's impossible to know what's going to happen in the future unless you have some kind of psychic ability. But generally, as traders, we can't really know what's going to happen in the future. But the future line of demarcation is demarcating areas in which we expect price to do certain things. And that's why it is such a powerful line. It is an extraordinarily simple line. It is actually simply price displaced forward by half the wavelength. So it's a very, very simple line. You can plot it on any trading platform anywhere. Or any trading software, you can plot an FLD. All you do is you take the median price, which is the mid price between the high and the low price of each bar, and you plot that median price forwards by half the wavelength. But that's the catch, of course. What is the current wavelength? Because it has to be displaced forward by the wavelength that the cycle is currently beating with. And now I'm going to mention a fifth principle that Hurst defined, the principle of variation. The principle of variation is one of those sort of really disappointing principles, because just when everything is really sounding very exciting, the principle of variation comes along and spoils everything. The principle of variation tells us that cycles are constantly varying in terms of their wavelength and amplitude. So the point is, when you have a 40-day cycle, perhaps, it has recently been beating with a perfectly average length of 36 days. But the current wave of that cycle, what is the current wavelength of that wave? The point is, we don't know. What we do know is that it's going to vary. And so because it was 36 days a month ago, it's not going to necessarily be 36 days today. It might be 36 days, it might stay the same, but it might vary, and it might vary by quite a lot. So it might jump up from 36 days all the way up to about 50 days. We could have a long, rather boring conversation about what the limits are to that variation, but I won't bore you with that now. But the point is that the cycles that influence financial markets are constantly varying in wavelength. It's what makes trading so exciting. If those wavelengths were always the same, it would be very dull. We'd be making money all the time. So the principle of variation tells us that the wavelength is varying. And because that wavelength is varying, in terms of plotting our FLD, we need methods and ways of calculating our best possible estimate of what that current wavelength is. And that is why you cannot actually plot an FLD properly on other trading platforms or trading software, unless you are, of course, performing your own analysis in some way or another, and you are constantly updating your assessment of what the current wavelength is. I do think it's impossible to know. It's one of those sort of strange dilemmas about Hurst cycles. It's impossible to know at any one time with 100% certainty what the current wavelength is. But of course, there are many methods and tools for getting very good, very accurate estimates of what is happening to the current wavelength. So once you know the current wavelength, you plot your FLD, which is that displaced line, a very simple line, as I've mentioned. And so what does that FLD tell us? In what way is it a future line of demarcation? Well, when price crosses up above the FLD, so remember the blue line here is price. So here's price moving up. When price crosses over the FLD, which happens over here where I've drawn a circle, you're able to generate a target. And the target is equal to the move that has preceded that cross from the previous trough. So here we have the previous trough down here at the bottom of the screen, and that price cross is happening, as you can see, at a level on this diagram of 40. Therefore, we're able to generate a target of an equal move to the upside at 80. And there you can see the peak forms at exactly 80. Okay, so that's the first piece of information that we are able to gather from an FLD. The second piece of information is that when price crosses up above the FLD and properly crosses it, it confirms that a trough of the cycle has formed in the market over here. That's meant to be a tick mark. So that's the second piece of information, is what might be called analysis information. So the first piece of information is trading information, really. It gives us a target for where price is going. The second piece of information is analysis information. It confirms that that trough has happened in the market. And the third piece of information that it gives us is that the FLD tells us to expect a peak at around about the time that the FLD is forming a trough. Okay, so there's the FLD forming a trough, and it tells us to expect the peak at around about the time that the trough in the FLD forms. Similarly, when the FLD forms a peak, such as over here, the FLD is telling us to expect a trough. So I read this. This was in Hurst's Cycles course, or Cycles curse, and I read this and I was very enthusiastic and jumped into trading it, and developed all kinds of sort of automated systems to just immediately trade as soon as price came along and hit an FLD, because clearly every time price hit an FLD, I was going to be able to generate a target and I was going to make some great trades. Okay, I was going to make this great short trade here, then here I was going to make that great long trade over there, here I was going to make another short trade, and I was just going to happily trade the FLD into my retirement, and that was going to be the end of the story. I soon discovered, however, that when you stop looking at these diagrams and you start looking at the markets, which we are going to do a little bit later in today's webinar, the markets behave differently. And at first I just put that down to the fact that the markets are not perfect. As as I often find myself saying, the markets aren't perfect, and cycles influence price movements. There are lots of other things that influence price movements. So you can't expect everything to be perfect. But I then started noticing a rhythm, interestingly enough, in my trading, which was that I would make a really good trade, and then I would make a losing trade, and then I'd make a kind of an okay trade, then another okay trade, and just about when I was about to give up, I would make my best trade yet, and then I would make a losing trade, and then I make another really good trade. So there was a definite pattern in terms of what was happening with the FLD. So I wondered whether there was something else to this whole FLD story. Now, as I mentioned, Hurst, as far as I know, never spoke about how price interacts with an FLD when there are multiple cycles involved, which seems like a really weird thing, because one of the big points that Hurst made was that multiple cycles influence financial markets. But then when he started speaking about the FLD, he showed pictures of only one cycle. It seemed it seemed a bit of a shortcoming with the approach to the FLD. So I started playing around and I combined 2 cycles. And if this system will, there we go. I combined 2 cycles. Now, I showed you the result of combining 2 cycles a little bit earlier. I won't go back. But this blue line here, again, is the price that results from combining 2 cycles, which are obeying Hurst's principles, as discussed previously. And again, this dashed red line here is the FLD. Now I noticed something interesting happening, because over here price crossed the FLD and it not only succeeded in achieving its target, which here would have been 120, but it actually exceeded it. That was why I was getting some really good trades in there. That was a great FLD trade. Then price came down to the FLD, crossed below the FLD and went nowhere, and then turned back up again. Here it crossed the FLD, went up a little bit. Here it crossed down below the FLD and dropped fairly steeply. So I realized that when you start looking at price as a combination of multiple cycles, which of course price is, I mean, you can't not look at price in that way. So when you look at price correctly as the combination of multiple cycles, and then start looking at its interaction with a particular FLD, and again, this FLD is simply the price displaced into the future by half of the wavelength of the cycle that this FLD is based upon. So this FLD is based upon the shorter of the 2 cycles that were combined to produce this diagram. So I then looked at combining more cycles. Having combined 2 cycles, I'd noticed something interesting sort of going on here. So I then combined 3 cycles, and this is the result of combining 3 cycles. So here is that price movement that we looked at earlier, the nice capital M shape, the M-shaped cycles, and there is your mid-channel pause on the left on the way up, and your mid-channel pause on your right on the way down. Okay, so that blue line is the result of combining 3 cycles. Now that dashed red line is again the FLD. So let's speak about what we can see in terms of price interacting with this FLD. First of all, price crosses the FLD over here, and it comes up and it achieves and indeed even exceeds the target, okay, on its way up, the target from crossing that FLD. Then price comes down and it very nearly touches that FLD. And I'll show you in a moment how the amplitude of the 3 cycles involved often result, the combined amplitude of those 3 cycles often result in it actually touching that FLD. So we've definitely got an interaction over here. Then it comes up again to its first peak. Then here we have another interaction as price drops down. Here we have another interaction as price crosses up. Here we have another interaction as price drops down. And here again, price comes to the FLD and almost touches it. So I observed this sequence of interactions that was happening when you combine 3 cycles. I then combined 4 cycles, 5 cycles, 6 cycles. I actually eventually combined 11 cycles, and I did similar things. I'm not going to do that to you today because, in fact, it's not really necessary. As I mentioned, the combination of 3 cycles gives us our core or fundamental shape, and it also gives us our core fundamental sequence of interactions between cycles. When you combine many more cycles, you take 11 cycles and you combine them and you're looking at the interactions, you actually find that, of course, there are variations on the theme, but the basic sequence remains the same. So let's just go through what that basic sequence is. I identified 8 interactions between price and the FLD. And the first interaction, this one here, is the A category interaction. Each one of these interactions has a character to it, and that's very important when you're working with FLDs and you're trading FLDs. The first thing you're going to want to understand is what the character is of each of these different interactions. Because if price behaves in a particular way when it approaches the FLD, you can begin to recognize the character of that interaction. And you can say, okay, that is not an A category interaction. Therefore, my analysis is wrong. Or perhaps, something is distorting the sequence. We're going to speak about distorting the sequence in a moment. But the important thing is to recognize the character. Sorry, I should have said that I'm speaking about the first interaction following a trough of the longest cycle out of my collection of 3. So you know that on an end-of-day basis, I trade the FLD trading strategy using a 20-day cycle FLD. The next longer cycle is the 40-day cycle, and the next longer cycle is the 80-day cycle. So the longest cycle in the collection of 3 cycles is the 80-day cycle. And so that 80-day cycle trough occurs over here at the left-hand edge of our chart. So the first interaction between price and the FLD following the 80-day cycle trough, or the longest cycle of the 3 cycles that you're considering, is the A category interaction. The basic characteristics of that are that it's a very clean cross. Price isn't held back by the FLD. It charges through it. It goes through it, and it very quickly fulfills the target and often exceeds it by a little bit. Okay. The second interaction is where price comes back down to the FLD. And so that's a short interaction. So A interaction is a long interaction, so I'll put an upwards arrow, and that we call the B category interaction, and that is where price comes back down to the FLD. At that point, the character of the B category interaction is that we expect price to find support at the FLD. It's not perfect. Sometimes it is perfect, and I love those moments where you see an FLD providing perfect support. But generally, the FLD will at this time provide some kind of support to price, as you can see it's doing here. So price comes down, but it just cannot keep moving further down. So it pulls up and away from the FLD, and so that is the third interaction, and that's the C category interaction. The character of the C category interaction is that it gives you a move which is usually shorter than the A category move, but it is a very reliable move. We've been tracking some statistics on the Hurst signal system, and the C category trades are the most reliable trades, without any question. They make money more frequently than any of the other trades, but they're in some ways fairly complicated trades because, can you see, we don't have a target. It's very difficult to work out a target for the C category interaction. So the C category interaction is quite a difficult one to trade because you don't have a target. It's very reliable. The price is going to go up, but how far is it going to go up? There are ways of calculating targets, but I'm not going to dwell on them here. This is really just a sort of an introduction to an overview of the FLD strategy. Okay, our next interaction between price and the FLD is a downwards interaction again. Price crosses down. That's a D category interaction. The character of the D category interaction is that it can sometimes be messy. Price can sometimes get a bit caught up in that FLD. That's the one thing to know, but usually you get a bit of a strong move. The other thing that usually happens with a D category interaction is that the target is very accurately achieved. Really, often within ticks, the target for the D category interaction is achieved, and price reverses very quickly. You've got to stay on your toes with D category interactions because you've got to be ready to get out. Okay, you've made a great winning trade, and before you know it, it's turned around and price has crossed back up above that FLD in an E category interaction. Okay, the E category interaction in many ways is similar to the D category interaction because it's the mirror. It's the sort of mirror side to the D category interaction. Price comes up. At this point, everybody starts saying, can the market make a new high? Is it going to make a new high? Isn't it going to make a new high? And we're going to look at the S&P 500 a little bit later, and that's exactly the question everybody's asking now. How high is it going to go, and all that kind of thing. So that's what happens when you get an E category interaction. And the other thing to be aware of with the E category interaction is that, again, the target is often very accurately achieved, and price turns down really quickly. And you've got to be careful. You have to be on your toes to get out quickly. I see some questions. The A category on this slide, the FLD crossing from up to down, is it correct? The A category, yes. The blue line is price. Sorry, I know that we're looking at sort of diagrams, so it's difficult to know which is price. The blue line is price, so price is crossing up. This arrow here, I shouldn't really have drawn an arrow there, so I'm going to cross out that arrow. That arrow was marking the 80-day cycle trough. Okay, so price is crossing up for the A category interaction. I hope that answers Nathan's question. Marco, wondering if there's some relation between theoretical target and support resistance when this target is overshot. Have you observed any? Yes, Marco. That's a fascinating field of research, and in fact, lots of people ask me how I trade. I don't just watch FLDs and calculate targets. When an FLD calculates a target, you have to look for other support and resistance areas, support and resistance levels within the area of the FLD target. Something I've observed personally, and you might find this different, but often if you get a resistance area, for instance, up at the top here, and let's say your resistance area is here, and your FLD target is just above that resistance area. I found probably, 8 times out of 10, the FLD is going to win, and price is going to come up and poke its head up above the resistance area, and just pop itself up above there, and then turn around again. So the FLD, in my opinion, but I am biased, in my opinion, the FLD is kind of the more powerful of the targets, but you should definitely use it in combination with concepts such as support and resistance, and looking at oversold and overbought values on indicators and things like that. But it's very useful in combination. Najmuddin, what is the assumption on amplitude of the cycles? Najmuddin, here again I'm working with an assumption of 1.35 as opposed to 2. So what that means is that the proportion of each cycle is 1.35 times, the amplitude is 1.35 times greater than the shorter cycle amplitude, as opposed to being double. We'll have a look in a moment. I've got some diagrams of when you do use it double, and you can compare it and see how it works. Let me quickly finish the sequence, then I'll come back and I see another question or two. So let me just quickly finish this sequence. The next sequence, when price drops down from its second peak, is this one over here. That's an F category interaction. They are one of my favorite interactions, and one of the reasons why F category interactions are so great to trade is because you've got this entire pattern before you. So you've been identifying these things, A, B, C, D, E. By the time you get to F, you've got a lot of information about these three cycles. You know how well balanced they are, you know what the underlying trend is, you know whether they're being distorted. So by the time you get to an F category interaction, it is often a real sort of no-brainer trade, because you've got so much information about your sequence this preceded it. Okay, so your F category interaction, you get a trade that comes down, it achieves its target, but then very importantly, it comes back up to the FLD where it finds resistance. And that's our next interaction, which is labeled, you probably guessed, G category interaction. So that's your G category interaction when price comes up to the FLD and finds support. Then finally the H category interaction for this final move down. Now you might be looking at this and saying the H category trade is definitely the best trade to get into. It's going to be a real winner. I must tell you that H category interactions in the markets are often fairly disappointing. For one thing, they're very difficult to identify, and they have the same problem as C category interactions, because it's very difficult to work out a target. At this point, your best chances for working out a target is to look at your underlying trend and work out where your trough is going to be relative to this trough over here, where the pattern started. That's your best bet really for working out the target. There are other ways of working out the target, which I won't go into here. But H category trades are great trades. They are real winning trades, but they can be very difficult to get into. They're also very psychologically difficult, because at around about this time, as price is bouncing up into its G category interaction, that's when everybody is starting to wonder whether that trough has occurred. And so G category and H category trades are really quite difficult, because that's when everybody is beginning to say, is this trough over here the trough of the big cycle that we've all been waiting for? Has it happened early? And of course, sometimes it has happened early, and so you were sensible not to go short. But oftentimes you'll see price coming up to the FLD. The key with all of these interactions is to watch the interaction between price and the FLD. And I really mean watch it. Watch the bars. Watch the candles that are formed. See whether the FLD is providing some resistance. Because when price comes up to a potential G category interaction, some of you will be thinking, oh, this is maybe an A category interaction. And some of us will be thinking, no, I think this is a G category interaction. You always have that question in your mind. Every time you're saying, is this G or could it be A? In the Hurst signal system, in fact, the Hurst signal system says we're expecting a G category trade, but consider an early A category trade, because you always have to, because of that principle of variation. So whenever price comes back up to the FLD, you're saying it should be G, but it might be A. So the important thing is not to sort of stand there like a deer in headlights and say, well, I don't really know what's going to happen. What you have to do is you have to watch price action. If price comes up to that FLD and is really sort of struggling to get through it and is meeting resistance, then the chances are good that you're going to get an H category downward interaction. If price slices cleanly through that FLD, hardly even noticing it, then chances are good that that's your A category interaction, because that is your character of your A category interaction. Okay, so that's your full sequence from A through to H. In a moment, I'm going to get to the real purpose of today's webinar, which is what happens to this sequence of interactions when the market is distorted, when you have a strong bear market or a strong bull market. So we're going to look at that. I see some other questions here. Does interaction E result in price exceeding the D FLD level and C move amplitude? Okay, so that's a really good question. I can't see your name because I've got some kind of a funny green box saying, do I want to do a live chat in front of your name? Sorry about that. But that's a really good question with the E category interaction. Does price come higher or doesn't it come higher? And the answer to that question has to do with the longer cycles, or what we call the underlying trend. The underlying trend is the combined result of all the longer cycles. So the answer to that question lies in the underlying trend. And we're going to see it in a moment. But I'll just sort of cut to the chase with it. If your underlying trend is bullish and all your longer cycles are pushing up, then you expect your E category target to be higher, because the longer cycles are going to push it higher. If your underlying trend is bearish, then of course you expect your E category target to be lower. Okay, hope that answers that. Najmuddin says, in the figure, the FLD is displaced by the shortest cycle period. So we are looking at 2 cycles longer. In your opinion, that's the right approach? Yes, Najmuddin, if you combine more cycles, you'll get a similar thing to this. I'm not going to waste time with it now. We don't unfortunately have time in today's webinar. But you can combine 4 cycles, 5 cycles. I went up to 11, and the interaction basically remains the same. This is like your core shape. This is your you can work with this model and just project it up. Of course, things get more complicated when you throw in a cycle with a 3-to-1 harmonic ratio. I'm not going to go into that in today's webinar, but things get a little bit more complicated. You get double C's, D's, and double E's and F's when you have a 3-to-1 harmonic ratio. But yes, the FLD is displaced by half of the shortest cycle's wavelength. So we're looking at a set of 3 cycles. That's right. We're combining 3 cycles, 2 cycles longer than the shortest cycle. And in my opinion, that's the approach. That's the best approach. That's the approach that works. Okay, let's move forward. So now that you understand the sequence, and I hope you're going to start identifying this sequence, and if you're not a Hurst Signal subscriber already, no, probably many of you are, then take advantage of our first month 50% offer and start looking at it, so that you can get used to identifying these interactions. Once you start identifying these interactions, there is really no looking back, I don't think. Let me see if I can move on to the next slide. Here we go. Okay. Is that the slide that I wanted? Here we go. All right. So I've spoken about the fact that I am not using the correct proportionality. I'm not applying the principle of proportionality correctly. I'm not adjusting my amplitude directly in proportion to the wavelength. So what happens if you do that? Well, this is the result of almost doing it, and you can see some things happening here. And I'm not just showing you this for interest. I'm showing you this for a very important reason. When the amplitude of the cycles is more correctly in proportion to their wavelength, then here is what tends to happen. The BC category interaction pulls away from the FLD, and the GH category interaction also pulls away from the FLD. Can you see that? It doesn't reach the FLD. Now, when you start looking at these and identifying these interactions in the market, you are going to see that actually very often the FLD does provide support and resistance, which is why I find the 1.35 proportionality ratio works. But this is applying a ratio of 1.7. So we're still not quite correct. There are a few other details to mention in terms of how far each of the interactions goes towards achieving their target, and the fact that the A category interaction, as you get more correct proportionality, the A category interaction really well exceeds its target. It just shoots way beyond it. Okay, so there are quite a lot of detailed points to make there. I don't have time in today's webinar to go through all of them. Let's apply the correct proportionality. This next slide, if the system will show me the slide, there we go. This next slide shows me the correct proportionality. So now here you can see that the B category interaction isn't even a move down. Okay, there it is over there. And it doesn't get anywhere near the FLD. Okay. Sometimes, of course, you do see the correct proportionality happening in the markets. And in which case you see the B category interaction just simply moving towards the FLD. It doesn't even reach it. And you see the same thing happening over here. So that's what happens when you apply the correct proportionality. And it would be very useful for you, perhaps a little bit of personal study. I'm going to set you some homework. It would be very useful for you to go and fiddle around with that and adjust the proportionality. In fact, what we'll do is make this spreadsheet available for download. I haven't organized that yet. Apologize for that, but I'll make the spreadsheet available for download, so you can play around with it and adjust the proportionality and see what happens. In my experiences, I've mentioned the 1.35 proportionality is really the closest that you get to what the markets actually do. Okay, so let's see. I see another question. Oh no, it's a comment from Elizabeth, who had a power outage. Oh dear. Is that Elizabeth, I think I'm correct in saying, is in South Africa. I hope that's not a reflection on the state of the power system in South Africa. So let's now take this a step further and get to answering the question that I was originally asked to answer, which is what happens to the FLD sequence, the sequence of price interactions with the FLD. What happens when you have a strongly bullish market? So we're going to start gently, and what I've done here is I've applied a longer cycle, because what is a bullish market? A bullish market is really just that there is a much longer cycle that is influencing the markets to move upwards. Okay, that's what a bullish, a really strongly bullish period of time is. It's a longer cycle moving upwards. Okay, so here we can see what happens, and in very simple terms, you can see that our M shape has been twisted to the upside. Okay, so our M shape looks like a kind of a skew M. You've got a higher second peak and then it doesn't come all the way down again. So that's the first thing that happens. And you can have a look at all of these interactions for yourself. You can really focus on the detail if you like, but I'll leave you to sort of figure that out for yourself. But the important things to note is that, of course, in the bullish market, your A category interaction over here achieves its target and then far exceeds it. Okay, comes right up to here. The B category interaction, the market doesn't even reach the FLD. So you can't really be sitting there if you're waiting to get into a C category interaction. You can't really be just sort of sitting there waiting for the price to touch the FLD, because if you've got a strongly bullish market, it's not going to get to the FLD. So how do you know when your C category interaction has started? Well, that's when you turn to your analysis, because what is your analysis saying at this time? Your analysis is saying that a trough of your shortest cycle has occurred. Your first trough of your shortest cycle happens at the B category interaction, or it happens, strictly speaking, between the B and the C category interaction. So even if price hasn't reached the FLD, if it looks as if though it has formed a trough of the 20-day cycle, if you're working with 20, 40, and 80-day cycles, if it's formed a trough of the 20-day cycle, then your C category interaction is ready to go. So that's what's going to happen, is price is going to bounce out of your 20-day cycle trough in a C category interaction. Your D category interaction is affected by the fact that there is bullishness, but interestingly, it isn't affected nearly as dramatically as you might expect. It still generally achieves its target fairly accurately, and there are various reasons for that, but I'm not going to dwell on them now. Your E category interaction is a very good interaction, because in answer to that earlier question, of course, price is coming up to a higher peak over here, and so the E category interaction exceeds its target on its way up. Your F category interaction is one of those trades where you get into the short trade, and as soon as you've got into the short trade, price comes bouncing up, and you think, oh no, I've made a terrible mistake. Well, perhaps you have made a mistake going short in a bullish market, but the point is, the price is still going to come down to form its next trough over here. And so what you would do is you would watch very carefully what price does when it gets to that FLD, because it's coming back and it hits that FLD, and you can see it tracks along it, it moves along the FLD, it finds resistance at the FLD, and then it moves down in your H category interaction. Okay, so that's what happens when you apply a little bit of bullishness. I see Don says, what works best, daily or weekly bars, or even 60-minute bars? Okay, so let's spend a moment just speaking about that. Simple answer is daily bars work best. A more complex answer is that the longer the FLD you're looking at, you need to work with different bars, and I hope we're going to have time. We've only got just a sort of 10 minutes left, but I hope we're going to have time, and I'll show you the difference between daily and weekly. Okay, what about 60-minute bars, or hourly bars, or 1-minute bars? Does the FLD trading strategy work intraday? The FLD trading strategy is alive and works very well intraday. I'm not sure if David is doing his trading room again, but I know David works with FLDs a lot in his trading room. So hopefully you'll get a chance to go and look at that if he's busy doing that trading room this week. The FLD trading strategy works very well intraday, but the sequence intraday is much more complex, because I think there are more complex harmonic ratios in the intraday realm, and so you get much more complicated interactions. My best advice to you to get started working intraday is to watch what happens when price interacts with an FLD. Don't rely on the fact that you are expecting definitely, you're expecting an A, B, C, D, E, F, G, because it gets much more complicated intraday. If there's a 5-to-1 ratio, or potentially there's a 7-to-1 ratio in some markets, things get very complicated in the sequence. So the important thing is don't rely on your sequence, but watch what happens when price meets an FLD. I know somebody who trades very successfully, and he literally watches price as it approaches that FLD. If it cuts cleanly through it, then he knows what's going to happen. If it is struggling to get through, and then and then turns down, then you also know what's going to happen. So it's quite important to watch it. So let's just take this a little bit further. That's with a slightly bullish market, and let's have a look when we've got an even stronger cycle pushing upwards. This is a much stronger cycle pushing upwards. Do we still have our sequence? Yes, we do. First of all, let me show you the M shape. Here's your M shape, like that. Okay, it's not a very good M shape. That's a kind of a beginning M shape kind of a thing, but I had a warning message pop up. I think everything's okay. But nevertheless, you do have an M shape. Okay. What about our interactions? Well, I'm not going to do all of them, but let's just quickly highlight them. There's your A category interaction. Again, fulfills and exceeds its target. B and C category interaction, or your B category interaction, price doesn't even reach your FLD. C turns out to be a great trade, carrying up to the first peak over here. D category interaction. Now this is when the D category interaction starts kind of losing its power, right? I see Joachim has to go. Catch up with the recording. Great, thanks Joachim. Okay, so when price comes down in the D category interaction over here, it turns out to be a disappointing interaction. It's a very important thing. By the time you're entering into your D category trade, you've had 3 interactions. Okay, you've had your A category interaction, you've had your B, which didn't get near the FLD, you've had your C as it bounced up again. By the time it gets to the D category interaction, you would have to be fairly slow on the uptake not to have noticed that there's a pretty strong bull pushing that market. Okay, so you don't trade every single interaction. It's a really important point. Here's our E category interaction, which is a very successful, profitable interaction. Why? Because we've had a lot of bullishness. Is that bullishness a surprise? Well, no, because we've been seeing that bull pushing all the way so far. Here's our F category interaction. As I've mentioned, a trade that I love making, very, very good trade, but you've got to be really careful entering into an F category trade when you've seen such strong evidence that there's a strong bull pushing this market. Okay, so as you can see, the F category interaction is very disappointing. Now here's an interesting point. The G category interaction actually crosses up above the FLD. Now this is something you are going to see in the markets, and you're going to see it often. When there's a strong bull, your G category doesn't find resistance at the FLD, it breaks up above it. Very dangerous moment, because what is the question you're always asking when a G category occurs? You're asking yourself, has that trough formed, and is this an A category interaction? Very dangerous. That's where you stand to lose some money. If you're thinking, okay, this is an early trough that is formed, and therefore this is an A category interaction, you've got to be very careful. In fact, it's a G category interaction, and it's difficult to catch some of those because price does cross up above that FLD. It doesn't find support, and then somewhere above the FLD, as you can see, it sort of eventually finds not support, it finds resistance, and then it drops down again in the H category interaction, okay, which is this one over here. Let's sort of finish this and take this whole sequence one step further. And now we're looking at a really very powerful bull market. Do we still have our interactions? Yes, you do, but they're now getting very difficult to identify. There's our M shape. It's very, very spread out. Doesn't look like an M shape. It looks more like a straight line. Okay, what about our interactions? Here's our A category interaction. Great interaction. B category interaction. All that happens is that the distance between price and the FLD narrows. You see the price moves towards the FLD. Here's our C category interaction as price bounces up again. Here's our D category interaction. Now this is interesting. Price has come down and it finds support at the FLD. That's a really disappointing D category interaction. Would you have been trading it? I hope that already you're saying no, because I've seen so much evidence of bullishness. Why on earth would I be going short for my D category interaction? Okay, underlying trend is clearly bullish. I don't want to be going short there. Here's your E category interaction, looking really very, very good. And here's your F category interaction. Now that's what I would call a disappointing interaction, because in fact price didn't even cross the FLD. It came down, found support at the FLD. And here's so that's your F coming down, here's your G going up, and here's your H coming down. So now your H is your strongest short trade. So in fact the only trade that would have potentially even achieved its target, the only short trade that would have potentially achieved its target in this very bullish scenario is the H category trade, which is why when you've got a very bullish market, you're not going to trade short anything except a move down into the 80-day cycle, perhaps, obviously depending on your time frame. Zach says trade the trend. Exactly. You don't want to be locked into your sequence just because D category is a short trade. Okay, if you've got a very bullish market, you don't trade it. So that's what happens if you're trading a bullish market. The sequence is still there, but you've got to be sharper. You've got to be a little more on the ball in terms of identifying those interactions. But the interactions are still there. The important thing to remember is to combine these interactions with your analysis. Okay, so the B category interaction occurs when the 20-day cycle trough forms. The D category interaction is the move down into the 40-day cycle trough. So you're looking at your analysis, you're watching for your diamonds, you're hoping those diamonds are going to form. Okay, F and G normally happens at about the 20-day cycle. Although that's much less reliable, it's worth me saying. And then, of course, this happens, with your big cycle over here. So remember to keep referring to your analysis to track what's happening with your interactions. Let's just to quickly sort of complete this part of it, and then I'm going to show you a few charts, and then we're going to be done. What happens when you get a bearish interaction, a bearish market? What happens to your interactions in a bearish market? Well, the same thing happens, but to the downside. I'm going to sort of rush through this because we've really sort of covered it. But your A category trade, which is normally your strongest trade, will still be a strong trade. B and C, you can see, are touching very nicely over here. But C is not so profitable. D comes down and is much more profitable than it is usually. Okay, you can see it exceeds its target. Why? Because your market is bearish. Your E category comes up, and similar to the discussion about the bullish market, with the D category thing, it actually fairly accurately achieves its target. And this is when you get the most magnificent F category trade. Of course, when you have a bearish market, it comes down. The G category doesn't even come up and touch the FLD, and your H category, it just all flows into one magnificent short trade. Let's go even more bearish, and let's see if I can change the slide. If you go even more bearish, we're seeing exactly the same thing as we saw with the bullish market. Here is the A category trade. A category trade still achieving its targets. A category trades are remarkably resilient, like the H category trades in a bullish market. They're the ones that are really going to be the ones that work. Here you can see your B category interaction price drops down below the FLD. C, it just manages to poke its head up above the FLD. D category is really good, profitable short trade. Not a surprise because we have a bearish market. And here you have the E category, and here you have the F category. E category not quite fulfilling its target. F category, a great short trade. Of course, in a bearish market, you're going to be looking for those short trades. You're not really going to be looking for the long trades. You've got to be very careful very careful not to make the mistake of, in the midst of a bearish market, saying, okay, that trough is going to be the big turnaround point, and I'm going long. You don't go long until you've seen some evidence that the market has turned around. I see another question. I'm going to get to it in a moment, but let me just go finish off the bearish discussion with a very bearish distortion of your interactions. Here's your A category trade. As you can see, it actually does just achieve its target, but it was only slightly below the FLD. Here's your B category trade where price comes down below the FLD. The C category interaction only actually takes price up back to where it finds resistance at the FLD. And there's your D category all sort of combined in there as it drops down away from the FLD. Here's your E category where price finds resistance at the FLD. F category where price drops down below the FLD. G and H, you can see price doesn't even get near to the FLD, it approaches it, and here's H for your final drop down. I see Don says, what are anecdotal results trading daily SPX individual stocks or commodities? Okay, so I'll come back to that if I can, Don, because I have a few things to say about that. And how would you rate the three categories? Okay, well, of course there are 8 categories, but I assume you're saying the 3 categories that you mainly trade. In fact, the categories you can mainly trade are 6 of them. You can trade the A, C, D, E, F, and H categories. They can all be traded. The best trades to take. In fact, that's a really important question. So let me just speak about that for a moment, and which are the best categories to trade. And here we go. Let's just work with this chart here. Okay. My best category to trade is probably the F category trade, which might surprise you because you thought I was going to say the A category trade. In theory, the A category trade is the best to trade, but I've got to tell you, A category trades are very hard to identify in time. Why? Because the market's heading down towards the trough, and you're trying to identify that trough, and you're wondering, is it too late? Is it correct? Is that trough happening? And while you're busy thinking of all that, the A category trade happens. And if you stand by to get long early, then you often get trapped by a G category trade. I hope that makes sense to you. So the A category trade, although it's a great trade to do, it's a very difficult trade to make in practice. My second favorite trade, on the other hand, the F category trade is much easier because you've seen 5 of your sequence, so you know what's happening in this current sort of collection of 3 cycles. You know what's happening in the market by the time you get to an F category trade. The F category trades are really good. My second favorite is the C category trade over here, because you've seen an A. Perhaps you missed the A. You've seen price come down to the B. Price is behaving in a typical B category manner. It's tracking along that FLD. That's when you want to go long in your C category trade. So my favorite trade is F, my second is C, and D and E come in for about sort of equal measure. I would only take a D category trade if it looks like a bear market, and I would only take an E category trade if it looks like a bull market. Okay, so there are my favorite 3 categories, although there are 4 of them. Okay, and Don says, are results better for stocks or commodities or ETFs? Okay, so let me speak about results. We've been doing the Hurst signal system, which has been producing. The Hurst signal system provides an analysis, and it identifies these interactions. That's what it does. It tells you what interaction to expect next. It tells you what the level of the FLD is, and it provides you with where you would position your stop loss and what your target would be. Okay, but it is a signal system that requires a lot of discretion. I see somebody there, Richard, saying, can this be auto-traded? There are many people that are involved in sort of putting together auto-trading approaches to it. Yes, I've done quite a lot of it. Bottom line, can it really be entirely auto-traded? I'm going to say no, because there's quite a lot of discretion involved, as you've probably understood. I think there's a lot of discretion involved in terms of how is price interacting with that FLD. I say it glibly, but how do you define it? Price interacting with an FLD. Okay, I know I've spent a lot of time writing code to do exactly that, but it's a fairly complex process. So can it be auto-traded? Potentially, yes. I'm not entirely sure. But to get back to how it performs, we've been doing the Hurst signal system now for almost 3 years. The Hurst signal system identifies all of these interactions. What we've been doing over those 3 years is gathering statistics on it. And we are in the process now of putting those together. Finally, it's been something we've been wanting to do for a very long time, but finally we are putting all those statistics together. And those statistics tell you if you had traded every single one of these interactions, which, as I've kept mentioning today, you shouldn't, of course, because you've got to look at what else is happening in the markets. But if you traded every single one of those, then we are going to be we're going to have a whole bunch of statistics and a lot of statistics. Not just win ratio, but also what your average win was, what your average duration was, all kinds of stuff. So that's quite exciting. I can tell you statistically, the C category trade wins hands down in almost every single instrument. Other instruments that work really very well are the stock markets work well. First of all, stock market indices work well. The big currencies such as euro, US dollar work well. Japanese yen does not work well, probably because it involves peaks. And I don't want to spend too much time speaking about that, but I think it works with the synchronized peak analysis. Gold has the trough analysis has been very poor recently. I think I'm correct in saying, but those statistics will be available soon, and then you can have a look at it. You can compare all the different instruments. Okay, Curtis, the 8 turning points have an interesting resemblance to the classic Elliott 5 motive waves and 3 corrective waves. Yes, thank you for bringing that up, Curtis. I love having this conversation, and so I'm going to give you my very quick Elliott wave meets Hurst cycles moment. In fact, I can just do it. No, let me do it with a bullish market. So I'll go back to a bullish market slide. I'll show you how Elliott wave fits into this, in my opinion. Very roughly. This is not really the right one to look at, but you're looking for a 5-wave move up, 1, 2, 3, 4, 5, and then a 3-wave move down. Okay, oops, 3-wave move down. So you have your 5 waves up, and you have your 3 waves down. That's that's really the key to how Elliott and Hurst work together. Very interesting observation. Thank you. And Louise, how do you do this analysis on the 54-month cycle? That's kind of complicated, Louise, because you have a 3-to-1 harmonic ratio. There's not going to be time in today's webinar to speak about the 3-to-1 harmonic ratio, unfortunately, but it does get more complicated. Richard says, does it work with grains? We don't actually have any grains on our Hurst signal system. The reason for that is because grains work much better with a peak synchronized analysis, and peak synchronized analysis turns everything upside down. We are introducing grains, but I don't have any statistics really about how it works, I'm afraid, Richard. Marco, I suggest to divide A, B, C, etc. in categories in zones. Okay, that's an interesting suggestion. So define zones for each one of them. I think that Marco's saying. Zach's saying a new book. Yes, indeed. I'm working on it. Do we have a list of the data or the stats? The stats is going to be available on the Hurst signal system. It's not available yet. Let me tell you, you're not going to find it there yet, but it's coming. It should be there really soon. We've done all the work, so it's just a matter of publishing it. What I'd like to do now is just quickly rush through. We've gone very long, and I need to bring this to an end soon. I just want to quickly show you some examples of the FLD in the real market, because it's all very well looking at these diagrams. This is a screenshot from Friday, and this is what is this? A 15-minute, no, this is a 1-hour chart. So Don mentioned the 60-minute chart. This is a 1-hour chart. And this FLD, the red line, is the FLD for the 2-day cycle. So look at what happened here. Here we have a trough of the 10-day cycle forming in the market. What do we expect first? We expect an A category interaction. There's our A category interaction. Look at how price steamed through that FLD. Can you see? It just shot through the FLD, and it then went ahead and achieved fairly accurately, as far as I can tell without looking at the exact numbers, achieved fairly accurately its target. Can you see that? I hope you can. Then what happened? Price came down and it found support at the level of the FLD. That's the B category interaction, and possibly the C category interaction is in there as well. I stopped trusting the markets sort of fairly late on a Friday afternoon, particularly if there is news, as there was last Friday, because then you get a lot of sort of running, big strong movements that don't really have anything to do with cycles. Okay, so there's an example of it in the markets, and I think I've got some other charts here. Colette says, will I go over where we are in the cycles now? We're going to take a very quick look at the S&P 500, Colette, and the euro to US dollar. So here is a chart. In fact, I'm going to have to rush through these, unfortunately. I don't think they've got a huge amount of extra very valuable information, but plot some FLDs on your charts and go and have a look at how often you see price clearly finding support or resistance at the level of an FLD. It's something that you see happening time and time again. Let me move through. Here we've got another one. You can see again an example of price coming down. In my opinion, this is probably an F category interaction here as it drops down, comes back up to the FLD. Look at how it finds resistance to that FLD, tracks along that FLD for many bars. That's the G and H, in my opinion. And then our H brought us down to where a potential trough is forming. It might not have formed yet, of course. Okay, and in a moment we're going to get to a longer time frame chart, and I can speak about what it looks as if those happening. Here's another interaction. It's with the 160-minute cycle. 160-minute cycle is one of my favorite cycles, but we're not going to have time to speak about that here. Here's the euro to US dollar. This is a 4-hour chart, and this is the 20-day FLD that you see over here. Here you can see the analysis has identified an 18-month cycle trough over there, but look at how price only just managed to drop down below the FLD. So where's our interaction here? Well, it's over there. That's our A category interaction. We expect it to come up. What's the B category interaction? Price comes down and touches the FLD. But it did that in this case at the time of the 10-day cycle trough. So this is a particular thing that happens fairly often, which is that you get a double BC category interaction. So that's what's happening in the euro to US dollar. Now let's take a look at the S&P 500, and we can see what's happening to those. As I mentioned, for our Hurst signal system, if you go to our website and click on any of the buttons about Hurst signals or menus for Hurst signals, so you go to sentienttrader.com, go look at Hurst signals. We're offering half price off your first month for January 2017. That's the code. You just enter all capital letters, January 2017, and you'll get yourself a 50% discount. Because the Hurst signal system also comes with a training course which discusses this in much more detail. So hopefully you'll find that interesting if this has piqued your interest. So let's quickly take a look at the S&P 500, and unfortunately we've really run out of time here. But I have some charts of the S&P 500 to look at, and so this is what's happening at the moment in the S&P 500. And let's just go back a little bit and scoot that over. There we go. So we had a trough that happened here, probably, in my opinion, a trough of the 18-month cycle that happened in February of last year. So we're 11 months into that 18-month cycle. And in fact, let me turn that pen off and let me put on a different FLD. And this computer looks as if it's there we go. And let's put it on the 80-day FLD. Right. So let's have a look at this 80-day FLD and see if we can identify the sequence in this 80-day FLD. First of all, let me just clear that mark. First of all, here's your A category interaction. Where's your BC? Well, it interestingly slipped over a little bit. So that's probably B over there, and that's C over there. Here's your D as price comes down into the 20-week cycle trough. Here's your E as price comes up above it. Here's your F, and let me write F there. Here's your G as it comes back to the FLD, finds resistance. Here's your H. Now, you can see the distortion that's happened in that market because of what? Because of a really strong bullish influence. Okay, that's the distortion that we saw in the earlier charts, the earlier diagrams of what happens when you have a fairly strong bull market. So we still have a fairly strong bull influence, obviously, in what's happening at the moment. So let's just zoom in and take a look at the 20-day FLD and speak about where we are in terms of, and in fact what I'm going to do is I'm going to turn off peaks, because there's a whole conversation that's going to take us another 3 hours to do in terms of how this relates to peaks and so forth. But here you can see your interactions with your 20-day FLD. There's your A category interaction. Now the B category interaction you expect round about the 20-day cycle. What happened there? Well, nothing. But here's a really good B category interaction. Can you see? Price came down and found support. So I'm calling that B. And there's C, pops up again. Here is D as it comes down again. I've written a B. That's a D as it comes down into the 40-day cycle trough. So that, in my opinion, is probably a better position for the 40-day cycle trough. What did we have then? We had the E category interaction. What comes next? F. Okay, so somebody asked, I think it was Colette, asked, what about the markets at the moment? Okay, so let's speak about what's been happening here. We've got a fairly good sequence. First of all, it looks as though the cycles are stretching. Okay, so because we've got our 40-day cycle trough probably happening over here, so we've got a scenario where cycles are stretching. The market has been fairly bullish, but not extraordinarily so. Look at how the B category interaction came down to the FLD and actually dropped slightly below it. That's not a tremendously strong bull. So there are some indications that the bull is losing strength. It really struggled to get down through the FLD for the D category interaction over here, which is a fairly bullish sign. But look at what's happened since it crossed up above the FLD. The E category interaction hasn't even achieved its target yet. The E category interaction would achieve its target with one more push up. So we've definitely got a bull that has been moving the market. When we looked at the bigger term picture, a very strong bull from February last year. This sequence that we're seeing now on these charts would seem to indicate that the bull is beginning to run out of steam. I have to be careful what I say. That doesn't mean I'm bearish all of a sudden, but it does look as if though the bull is running out of steam. Why? Well, because this B category interaction, price came right down to the FLD. That's not a very bullish scenario. This E category interaction hasn't achieved its target yet. It's not very bullish. I wouldn't be surprised to see the markets push up to a slightly new high to fulfill that E category interaction, because it should be fulfilled. But then we're looking at an F category interaction with the markets moving down. Be a little careful of that F category interaction, because we have had a bullish market and it's going to take a while for the bull to run out of steam completely. But the fact that the bull is definitely weakening would be an indication that it wouldn't be a stupid trade to make. I'm not staying clear of it. I'm probably going to consider getting in for that short F category trade. I hope that answers that question. Let me see what other questions are. There are a whole lot of other questions. Nathan, can you add watermark for the chart, please? Okay, Nathan, I'm not entirely sure what you mean by that. I'm sure we can add a watermark. You'll just have to let me know what you mean by that. Alain, compare FLD interactions with price of David with elite wave diagram of Richard Ingram, I think Alan is speaking about, and he's provided a link there. Okay, thanks, Alan. That's interesting. So, same kind of graph was produced by John Bollinger in Cycles and the Foundation of the Study of Cycles. That's right. I mean, this is not entirely. We're not the only people that have identified these sort of interactions and the way that cycles affect the market. Richard Bond, is there any New Year special for the trading system? Richard, are you speaking about the actual software? There isn't a New Year special, but I'm sure if you contact us, I'm sure we can find a special somewhere for you. Peter Brown, for those interested, here's a great book by Christopher Grafton, Mastering Hurst Cycles Analysis. That's right. In fact, Christopher Grafton, I'm working with Christopher Grafton on the Hurst Cycles indicators. Anyway, more of that later. I'm not going to waste any more time. You can go to Script and read it online. Angela, is that low at the end of February for a turn? Right. Yes, that's right. So we're looking at the market coming down into February. So I can let me put on the composite model line and see what the composite model line is saying. I think I have a composite model line. By the way, as a matter of interest, whenever you're looking at the composite model line and you want to see what the markets are expected to do, remember to turn off sigma L. We've spoken about the composite model line previously. Okay, so that's the composite model line. We're looking at a final peak up here, perhaps end of January, early February, and then a move down. The composite model line just gives you another way of visualizing the analysis. It's not necessarily a forecast. And Ange says he means a watermark in the background showing what instrument you're on. Oh, okay, that's interesting. I'm sure, yes, to identify the instrument and the water frame, I'm sure that's something that we could do. It'll be very easy to do. We'll add it as a feature request in the software. And with that, I am going to have to bring an end to today's webinar. Let's see if I can find the slide to say goodbye. There we go. Thank you very much for joining me. Thank you so much for your interest in Hurst Cycles, and thank you for your time. I hope that you found the whole discussion of price interaction with FLDs interesting. It's something that's fascinated me for years. I've been trading them for years as well, and I hope that you will find that you can trade very profitably with them yourselves. So thank you again for your time. I look forward to seeing you to our next webinar, which will be in 2 weeks' time. If you have any questions that I missed, then please send them by email, and I'll be very happy to answer those questions by email. If you have any suggestions for things you'd like to hear discussed in these webinars, then also email us about that. So in the meantime, I wish you profitable trading, and I look forward to seeing you in 2 weeks' time.